Welcome to Alfonso Cajero, Financial Modeling Tutorials. Chapter 11, Mastering Sensitivity Analysis, a Guide to Financial Modeling Insights. Welcome to our video on sensitivity analysis for financial modeling. Sensitivity analysis is a crucial technique used to assess how changes in key variables impact a financial model's outcomes. By understanding these effects, you can better evaluate risks and make more informed decisions. What is sensitivity analysis? Sensitivity analysis involves altering one or more input variables in a financial model to see how these changes affect the model's outputs. This technique helps identify which variables have the most significant impact on financial results and how sensitive your model is to changes in assumptions. Why is it important? The importance of sensitivity analysis lies in its ability to reveal the robustness of your financial model. It helps you understand the potential variability in outcomes based on changes in key assumptions. For example, if you are evaluating a project's profitability, sensitivity analysis can show how changes in sales volume, cost of goods sold, or discount rates affect the projected net present value, NPV, or internal rate of return, IRR. How to perform sensitivity analysis. To perform sensitivity analysis, start by identifying the key variables or assumptions in your model. These could be factors like sales growth rates, production costs, or interest rates. Next, determine a reasonable range of values for these variables, such as a 10% increase or decrease. Adjust each variable within this range and observe how the outputs of your model, such as cash flow or profitability, change. Creating sensitivity tables. One common method for performing sensitivity analysis is by creating sensitivity tables, also known as data tables in Excel. These tables display the effects of varying input values on key outputs. For instance, you can set up a two-dimensional data table to show how changes in both sales growth and cost of goods sold impact the NPV of a project. This visualization makes it easier to see which variables are most influential and how sensitive your model is to changes. Interpreting results. Interpreting the results of sensitivity analysis involves analyzing the range of possible outcomes and understanding the implications for your financial decisions. For instance, if your model shows that NPV is highly sensitive to changes in sales growth, it suggests that revenue projections are critical to the project's success. Conversely, if the model is less sensitive to certain variables, it may indicate that those factors have a smaller impact on the overall results. Conclusion. Sensitivity analysis is an essential tool in financial modeling that helps you assess the impact of variable changes on your model's outcomes. By performing sensitivity analysis, you can identify key drivers of financial performance, evaluate risks, and make more informed investment and business decisions. Thank you for watching. If you found this video useful, please like, comment, and subscribe for more insights into financial modeling and analysis techniques.